wanted to pretend they could get it for nothing, or that somehow the rich would pay for it. But the rich aren't paying for it. The middle class and the working poor are paying for it, but they're not paying for it honestly through increased legitimate taxes. They are paying for it dishonestly through the inflation tax. But the main reason the government loves to pay for stuff with the inflation tax is because it never accepts responsibility for levying that tax. Instead, it blames it on other factors like greedy businessmen gouging their customers, or Vladimir Putin, or OPEC, or any other convenient scapegoat. And then what does government do? Government says, oh, now we need more laws and more regulations to protect the public from inflation. Government is the source of all this inflation, yet the government uses the inflation it creates as a springboard to even more government power. This is Black Friday, the day that officially kicks off the holiday shopping season, where Americans are supposed to go out and buy stuff. And this is considered economic activity in the United States. The fact that we go out and buy things, most of the stuff that Americans buy for Christmas, we didn't make. All this stuff is imported, and so it's only possible because of the economic growth outside the United States, not inside the United States. All we're doing is creating money, and we're exporting our inflation to the rest of the world in exchange for their goods. I mentioned about the holiday Black Friday, where Americans are out there shopping. The problem with Americans is we're consuming and not producing, and nowhere is that more evident than when you look at the ports. Because I mentioned that one of the things that Dubai has as an economic advantage is where it's located, and they're able to have a port. They have several ports, but their largest port is the 11th largest port in the world. And the reason that this port does so much business, it's not that Dubai is manufacturing so much stuff that it's exporting. What Dubai does is it imports and then re-exports a lot of stuff because of how efficiently it operates and because of the lack of duties. But I thought I would take a look just to put this in perspective when it comes to ports. Of the top 10 ports in the world, China has the #1 port, and it has 6 of the top 10 ports in the world, and it has 16 of the top 50 ports. The top port in the United States ranks number 17, and America only has 4 of the top 50 ports. Yes, the population of China is a little over 4 times greater than the population of the United States, and so they roughly have 4 times the number of ports that we have in the top 50, but they have 6 ports in the top 10, and we don't even have 1. Plus, even though China has a huge population, the per capita income in America dwarfs the per capita income in China. You would expect a lot more ports in proportion to the population here in the United States than they have in China, and that's not true. And the main problem is, when it comes to ports in America, it's one-way traffic, because stuff comes in, but the containers leave empty, and so there's a lot of trade that doesn't take place. Whereas in China, not only does China import a lot, but it exports a lot, and so the volume of the trade is much greater. Maybe we should move a little slower and give the markets a little more time to react to the hikes that we've already put in place, acknowledging the fact that there's a lag. So whenever the markets get that type of rhetoric from the Fed, the traders seize on it. And that's why you had the rally in the stock market. But more important than the reaction in the stock market is the reaction in the currency market. The dollar got hit hard on Wednesday, and in fact, it's falling again here on Friday morning. Then I think we could really start seeing a weakening dollar, which again is going to be very problematic for the Fed, because the weakening dollar is going to put more upward pressure on inflation. And ironically, of course, the reason the dollar is weakening is because the markets think that the Fed is winning its fight against inflation, and so it won't have to fight as hard in the future. And that is removing the supports from beneath the dollar, causing the dollar to tank. And now the very inflation that the markets thought the Fed was making progress in fighting is actually going to get worse. So the Fed will be a victim of its own success when it comes to inflation. But when the markets perceive this, I think it's really going to accelerate the movement out of US dollars and into alternatives. In fact, if you look at what's happening in the stock market itself, it's exactly what I've been forecasting with respect to the continued rotation out of momentum into value. I've been repeatedly saying that this next move up in the stock market is not going to be led by the leadership of the bubble, that these tech stocks, companies that don't earn any money, are not going to be leading the way. It's going to be value, it's going to be dividend-oriented stocks that are going to be the leaders in the next move up in the market. And in fact, not all stocks are going to move up. A lot of these money-losing companies are going to go down in an environment of high and rising inflation and rising long-term interest rates. But if you really want to look at some outperformance, look at the gold and silver mining stocks. This really is a stealth bull market in these mining stocks. Nobody is talking about a near 40% move up in junior gold mining stocks. Sure, a lot of people are pointing to the move up in the NASDAQ, which is a third of this move. This move is happening in obscurity, which, as far as I'm concerned, is great for the bulls. I don't want anybody talking about the rally in gold stocks. I don't want anybody buying gold stocks. I think what's probably going to happen is gold stocks are going to double, maybe triple off their lows before the mainstream media even starts talking about the rise. And of course, when they start talking about it, they may look at it skeptically. It may take an even bigger increase before they get on board. But that's why I recommend that people not wait for investing in gold stocks to become all the rage. Invest in this sector long before then, because that's when you can buy the stocks cheap. Because in order to buy something cheap, you can't be in competition with a lot of other people, because when you have lots of buyers, they bid up the price, and then the price isn't cheap.
So what we're basically seeing now is the Empire Strikes Back, right? And so if anyone has seen the Star Wars trilogy, the original one, you had the initial movie, and then you had a response to that, right? So if you look back in the past couple of years, we had this gigantic inflationary response. We had all these like speculations and things like that. And now we have a variety of central banks around the world, mainly the Federal Reserve, trying to fight back and regain some degree of a stability with their currencies. And the problem is that they're about 2 decades too late, right? So, a lot of these seeds were set in like the Greenspan era, the 90s, the 2000s. But nonetheless, with super high debt to GDP ratios, they're now trying to fight back and regain some degree of currency stability. And that's causing massive volatility in financial markets and specifically in sovereign debt markets, because that's ultimately the limiting factor when you get to the end of the road in terms of, kicking the can down the road. So we've had 4 decades of structurally declining interest rates, little cyclical rises, but mainly structurally downward. And that allowed for all this debt accumulation and, asset price, appreciation as well. But nonetheless, you have that combination of super high debt, zero or sub-zero interest rates, and then, real world constraints. Now you're running into a problem. Now you have interest rates going sideways to up, and this year mostly up, and that puts a lot of pressure on the whole system, right? So all those like dollars, like you had dollars in your brokerage account, based on your stock valuations, you had dollars in your bank account, you had dollars in your your treasury bonds, and all of those were supposed to represent claims for real world resources, right? But when the cost of those resources go up, and then the valuations of those financialized, second, third, fourth layer derivative assets start to go down, it turns out that the vast majority of those claims are not really worth, the real world resources that they thought they were, especially if a significant portion of the population tries to call them in at once. And that's essentially what we're going through. And that's what we go through in every kind of generational disinflationary to inflationary cycle historically. So indirectly, yeah. I mean, I think we can separate the problem into the proximate cause, meaning like the immediate cause, and like the core underlying cause. And so the core underlying cause is weak money. If you have weak money, artificial low interest rates, currency that keeps devaluing, there's a very strong incentive to, borrow money and buy hard assets, right? And so that's the structure we've been in for 40 years. Now, the proximate cause is when some of those things start to blow up. And so we had a bunch of proximate causes back in the 2008 crisis, and now we're getting another wave of those. Now, going back to the core cause, the fact that money is weak, interest rates are artificially low, and that's what allows for all of these constructs to exist to begin with and all of these perverse incentives. So, for example, if you are in a situation where you don't see a clear path where your assets are going to meet your liabilities, one of the options is to try to take more risk to have those assets meet the liabilities. And in the small percent chance that you're right, that could work out. But of course, any sort of wise person would hear that and say, unless you're Stanley Druckenmiller, you're probably going to mess it up, and you're probably going to be even worse behind on meeting your liabilities. And so that's, again, it's just another perverse incentive of the current system of weak money. And we can tie this, like, I agree with your point about fragility. Like, we can tie this back to, for a regular person running their own finances or running a small business. We can imagine a totally unlevered scenario, right? So you have no debt other than maybe like a small mortgage, right? That, with a very low, kind of like a loan to value ratio, but, virtually no leverage in your business. You have cash flows, you have expenses, and your expenses are below your revenues by a considerable amount. And so you have a high savings rate. Now, if you encounter a recession and you have a bad year, it doesn't feel great, but you don't go insolvent because you don't owe anyone anything, and you have a huge buffer between your like necessary expenses and your income and cash flows, right? So you go through ebbs and flows of the economy, and you're very resilient, even though, of course, some years are more enjoyable than others. Now, to contrast with that, if you have a extremely high leverage system, which can only exist in an environment of artificiality, right? If interest rates are artificially low, if there's an artificial incentive to borrow, if money is weak compared to real assets and therefore incentivizes borrowing that weak money to buy those real assets, it builds up all this leverage in the system. And then when you have a contraction, you're in a very different environment. I mean, if you owe a lot of money and your cash flows contract, you could go insolvent a lot faster compared to that prior example of someone who's totally unlevered and is just like riding the wave of the economy. And so we're in that second system globally, where we have super high debt to GDP ratios, debt to both on the sovereign level and the private level, and that's why we're in aggregate in such a fragile state at the current time. So you can trace it back to the individual private participants that made bad decisions, but then at the deeper level, you can tie it into the central bank and the policymaker incentives, where one, they always bail out the system when it gets bad enough, and two, they artificially lower interest rates in order to purposely incentivize higher debt accumulation.